Splendid evening it is to you viewers. Welcome to Equity News on Equity Access, your area of perspective of stock market developments and of developments of the Zimbabwean economy. Ibn Mabunda signing in. Let's get on to business. Our news tonight, trade figures for the month of January are out, with Zimbabwe's trade position improving by 153% to a negative $44 million. This, of course, is coming from a base of $198 million recorded in the month of December in the deficit position, for the purpose of clarity. Meanwhile, this of course is due to a decline in import figures to $337 million on a month-to-month basis, to reach the lowest ever recorded figure since November of 2017. Of note is the fact that key factors of production, which are diesel, soybean oil, as well as wheat, have declined 22%, 69%, and 29% respectively. However, exports have also declined by about 20%. Let's get into the figures so that you get insight into how it is that we are in this particular position. Right, so this is our exports against our imports over the past few months. That's from February right up until January. And as you can see there, we see that our imports have actually been on a decline from November right up until January, where also we also have the exports also declining in like manner. Thus, getting us that position of minus $44 million, coming from that position of $198 million. To get into the teensy-weensys of our trade position, Zimbabwe is coming from a position of, in 2010, where we had a trade deficit of $300 million, 2012 negative $4.7 billion, 2015 negative $3.3 billion, 2017 $1.7 billion in the negative, then 2018 minus $2.5 billion. But why is that important? Our trade position is important as it is an indicator of the competitiveness of our local industry as well as our forex earning ability, critical in determining the exchange rate in the local economy against other currencies. At the moment, we're grappling with forex issues as well as currency issues. So if that position actually improves, that actually spells positives for the country moving forward. I'll come back to that. As we make progress, let's get into the teensy-weensys of how it is that we're actually in this position, or what are the finer details in that sense. Our diesel there, imports getting to $61 million, petrol $36 million, aviation, spirits $10 million, wheat $8 million. Then we get into the exports position by value for nickel. Nickel, of course, in that sense was our largest forex earner, raking in $92 million in the month of January, as well as tobacco also lagging there to come into a position of $72 million. Then we have gold. Gold is a bit of a a scenario there. We could be producing better, but we know that there are concerns in as far as the miners are concerned, where forex retention issues are concerned. Well, this would be, of course, a month-on-month progression of how it is that we have got up to this place. Now, as I said, I would come back to the issue of our trade balance position. Well, earlier on, Equity Access investment analysts did look into the figures, and this was an earlier tweet. It says key factors of production inputs such as diesel, soybean oil, and wheat came off by a negative 22%, negative 69, 29 respectively for those. And then there's a caveat there that says, although a correction of balance of position is desirable, fears of a recession and further inflation in 2019 are growing against the imports trend. This, of course, they're making reference to the fact that our exports have actually been on a decline, which is not so much of a positive. Now, Captain of Industry Busisa Moyo also tweeted in response to that particular tweet, and he says January is a bad month to assess economic position and causes and effects. Some procured large volumes of stocks for festive season, but demand was dololo because prices were high. Business was a bit unsure about direction. Assess the full quarter. So there, with somewhere says Wait a little bit, Equity Access. Let's see how the ball actually plays as we make progress in that sense. Meanwhile, Parliamentary Committee on Land and Agriculture today convened with a special focus on tobacco crop in light of the tobacco selling season set to commence on the 28th of March 2019. Zimbabwe Tobacco Association Chief Executive Rodney Ambrose says Zimbabwe will not achieve as high an output of 253 million kilograms that we recorded in the year 2018. Well, he spells out the reasons. Our Equity Access team was on the ground. Let's have a look.
So we don't expect the crop to be as high as the 253 that we achieved last year. Yes, there's more growers. Yes, there's more hectares being planted, but we do expect yields to be down. And I think that the quality will be very much variable because of weather out there.
Well, that's Ambrose there giving us, he's focused in terms of the performance of the crop in the next season. But let's have a quick look into how Zimbabwe has performed over the past couple of years. Well, that is 2018, where we did actually record a record high of about 250 million kilograms, coming from a very low base of about 20 million kilograms in 2004, which progressed 2010, where we achieved about 75 thereabout million kilograms. 2014, we recorded over 150 million kilograms. 2017, just about 165 million kilograms, and there we recorded about 250 million kilograms. So he says we might not exactly be able to reach that because of the factors that he did outline in that regard. Well, as we make progress today, yesterday actually, JSE as well as ZSE listed Old Mutual, which is parent to Old Mutual Zimbabwe, released financials for the 2018 financial year. Well, before we get into the stats, let's just have a quick look at who Old Mutual actually is, what their form of trade is, and as well as their footprint across the continent. Of course, Old Mutual is a pan-African investment, savings, insurance, as well as banking group. The company was founded in 1845 in neighboring South Africa and has since expanded its footprint across Africa and even beyond over the past few years. Old Mutual is listed on the Johannesburg, Zimbabwean, Malawian, as well as Namibian stock exchanges, while maintaining a primary listing on the Johannesburg Stock Exchange. Let's take a quick dive into their footprint. Well, they have a clientele of over 12 million people across the continent and even beyond. Well, there you have it. They have a presence in South Africa, Botswana, Malawi, Namibia, Eswatini, Zimbabwe. That's for the Southern African region. Moving into East Africa, they have a presence in Kenya, Rwanda, South Sudan, Tanzania, Uganda. Then, of course, into West Africa, you have Ghana as well as Nigeria. Well, onto the crux of the matter. They, in their presentation of the financials, did make mention of the performance of the corporation in Zimbabwe. Now, in as far as Zimbabwe's operations are concerned, the group says it has had to adjust its book values as well as profits dating back to October of 2018. You would recall, of course, that then on the 1st of October, a monetary policy statement was issued by the Central Bank Governor, Dr. John Mangunjika, in which there was a separation between the Nostro FCA accounts or notional foreign currency accounts and the RTGS balances. And so where that is concerned, they felt that perhaps did not exactly do justice to the figures. Hence, they have now come in to say that where their figures are concerned for Zimbabwe from October to December, they've had to make an adjustment of $1 as to 3.3, which is the prevalent rate that we have on the black market. Mind you that on the interbank forex market that was introduced in the recent monetary policy statement, it's about 1s2.5 between the US dollar and the RTGS. This comes in just behind Simbisa as well as Axia that published their financials at a rate of 1s1, citing that, well, at that particular time between January and December, the central bank governor had said there was parity between the dollar and the then surrogate currency, the bond or the RTGS. So it then becomes a question of who is more accurate in this case. Is it these that are published at 1s1, or we actually have more insight where these that have actually come in to say it's 1s to 3.3, having taken different factors into consideration? Well, as we make progress, KEBS, which is Zimbabwe's largest building society, owned, of course, by the earlier stated Old Mutual Zimbabwe, which is in which Old Mutual Limited, which is listed on the JSE, has a holding. So, in a sense, that's KEBS' grandparent. Well, they have moved from a position of $352 million in their loans right up to $765 million. Can you imagine that? So that would be, of course, almost doubling what they had in 2014. Well, for a conversation on these and other issues, I'm joined in studio by our resident chief analyst, Respect Gwenzi. Well, Respect, good evening and welcome to the show.
Thank you, Eben. It's always my pleasure. Good evening, viewers.
Beautiful. Let's get the ball rolling, Chief there. Well, trade figures for the month of January are out, and it seems as though our trade balance position is actually improving. Let's just take out the graph there and just get into the nitty-gritties thereof. And if you could just back there for me. Well, we're coming from a trade deficit of $198 million to $44 million. What is your interpretation where that is concerned?
This is a significant improvement from the prior year as well as the prior month, and I think it is the most improved trade balance position since November of 2017, where we achieved a positive trade balance. But that was against the impact of tobacco, which normally is exported in November onwards. So we had a slight jump in November of 2017 as well as November of 2018, but rather in 2018 we had so much import pressure, so we couldn't really turn back the net trade deficit position. But in terms of the negative 44 million, I think it's important for us to get deeper into what it really means, because there seems to be a clear sacrifice of certain imports, which we need to really zoom in on and see what could be the payoff locally in terms of local produce. So the biggest losers were diesel, wheat, as well as soybeans, which we correctly picked as factors of production, because these are used in the day-to-day production of goods and services in Zimbabwe, of goods in Zimbabwe. So they are significant in that once you lower them, you are likely also lowering the pace at which you are producing in the economy. So it's not as very much a good indicator. Where production comes off, it also means that your GDP is likely to come off as well. So I don't think it's really a very good indicator in terms of how we have reduced our imports. And as well, there's been a sharp decline in terms of our exports. Key to note is that from the third quarter onwards, there has been a very huge decline in terms of our gold exports. If you see September going backwards, we're having a 6-digit export figures in terms of gold. But that has since changed from October upwards, up to date. So that also shows that our earning ability is declining although we are thwarting inputs, which in this case are productive inputs, I think the matrix doesn't work out well. It means we are likely to earn less from what we are exporting because production is coming off, whereas key earners of forex are also easing. So it's not really a good indicator, but there has been consensus from the industry as you picked earlier.
Yeah, well, Equity Access, they're
Yeah,
going
sure.
head to head with Busisa Moy, the Equity Access team. They highlighting.
So our position was that once you lower factors of productions, importation of goods that are instrumental in production, then it also reduces your production, and consequently it might lead into a recession. And whereas you produce less, you can also it might also result in inflation, where too much money chases too few goods. So all these things have to be balanced out. But this is a single month out of so many months. This is why one of the industry captains has to come out to say maybe you need to extend your period. And there are a lot of there are a lot of metrics around shifts in currency that were involved, and as well late in 2018 we saw the impact of split in split in RTGS FCAs and from Nostro FCAs, and then the latest monetary policy also coming up with its own changes. So there's been positioning in the industry. Some people were buying, were stocking higher input levels. So it means some had already pre-bought some of these some of the inputs that actually fell in terms of imports in January. So I think there are a whole lot of factors that one has to consider. So it's too early for us to judge whether the net import position is really adverse or positive. But from where it stands as of now, the decline in those three key aggregates, three factors of production, is not really a good trend to me.
Okay, but the central bank governor has also highlighted that there might be a possibility of a recession.
Yes, the very expectations of inflation, the very expectations of a recession are stemming from this trend where exports are actually falling, whereas also imports of key goods such as fuel are also coming down. So that's where he highlighted the issue to do with recession. And one other key factor is the aggregate demand. Incomes have been thinning. Zimbabweans' general income levels have come off lately because of things to do with inflation and increased taxation. So all that can militate to actually bring down demand, and that might also push the economy into a recession. So there are a lot of factors that are militating to drive the economy into a recession. And I want to believe 2019 can come out as a recession year. And I think we once pointed in an engagement with the Minister of Finance that fiscal measures of the sort that he had introduced in terms of austerity could work well in a liberalized economy. And the fourth quarter of 2018 saw us trading a currency which was 1:1 with the USD, and that really affected our trade as well. But now that we are operating with a liberalized rate, we might as well see a slight improvement in terms of our net exports. But that suffices to say we are producing. But if we are not producing, then we won't benefit from a liberalized exchange rate. So as we stand, I think we have a worrying trend in terms of our imports.
Now, talking about a worrying trend, at the Parliamentary Committee on Land and Agriculture today, we see the Zimbabwe Tobacco Association Chief Rodney Ambrose actually saying that we might be headed toward a decline in terms of our export revenues for tobacco. Now, if you just have a quick look at the stats, if you could just back that for me, please. Thank you. Well, tobacco is at the moment, in January, is ranking as our second largest earner at 72. And of course, in the year 2018, that also brought in up just about below $1 billion, which was the second largest earner for Zimbabwe. And now that they have forecasted that we might be headed for a decline, how worrying is that for the Zimbabwean economy?
Yeah, at the present moment, there are quite a number of factors that are at play as well in the tobacco sector. The issues to do with retention ratios, I'm sure they've been increased now for non-contract farmers from 30 to 50, and that's really an encouraging development. But on aggregate, the sector remains strong, and there are factors that are likely to affect the produce, as has been mentioned by the board, that we are likely to see a lower output in the current year due to the El Nino drought. So that's one of the key hindrances of production in the current year. But in terms of other factors, capital involved, and issues to do with how monies are likely to be paid, I'm sure all those are currently in position, although we are not likely to see an achievement of record levels. But projections are showing that in the coming year, there's a growth in the number of new farmers, and also the hectarage of land that is likely to be utilized for the purposes of growing tobacco. So all those are key important steps as we look forward into the 2019 to 2020 season. But in the current year, I think it has been spelled out. The produce is below the prior year due to El Nino, and we are not likely to see ourselves earning something close to $1 billion as we did this year. Maybe we might go back downwards to around 600 million thereabout.
I can't help but ask what the implication of that would be in terms of our forex situation.
Yeah, I think that's
the interbank.
Yeah, that's a very important. That's a very important trend. That's a very important question to ask. In terms of impact, generally, it means reduced export receipts. Whereas tobacco is usually the linchpin in terms of holding forth our banking sector, our financial sector, in the period between March and August when the flows are open. In this case, it might mean reduced flows within that period. And so it really has got an impact in terms of our ability to keep producing or to import, because we import based on what we export, because that's where we get the receipts. So all these are likely to be impacted, but the impact is not likely to be as significant. I think that's the general observation. But there's definitely going to be an impact, and that impact is slightly negative.
Okay, as we make progress onto an interesting sentiment there, as we are actually in the reporting season, as we got that statement there being released by Old Mutual Limited, which is parent company to Old Mutual Zimbabwe. Well, of course, Old Mutual is listed on the JSE and is actually the second largest insurance company in South Africa. Then, of course, that is what they've actually said against the operations in Zimbabwe, that they've actually had to work with a rate of 1:3.3. Oh, I wonder where they got that figure.
They were not as clear as to say we derived this from the black market rate. They said we considered so many factors on the ground, but it's something that they evaluated to say we had so many factors to consider, but clearly this wasn't an official market rate that was prevailing at that going period. So when you then look at the impact now, it was factored from a period between October to December, which is the last 3 months of the year. But some are of the view that such an accounting measure has to be implemented only from January onwards. So there's been a discrepancy in the market, some assuming to say we should start utilizing a 1:2.5 or a 1:2 market rate starting January, which means 2018 numbers are exempted. But Old Mutual chose to be prudential. At the point at which Zimbabwe splitted their accounts, the Nostros and the local, they said, let's come in, let's be prudential, let's factor in the real value of the Zim dollar, and they sure did justice by moving that rate close to what has been prevailing on the black market.
Real value, justice are the words that you've used.
Sure.
You seem to be of the inclination that these results are fairer than Exians and this results.
If anything, they are more fairer, because what could be the worst case? The worst case, rather, can only be seen to those that have chose to report in USD terms. those are the ones. If the PAAB decides today to say no, let's start accounting for the local unit, for the local currency from October onwards, it means those that have released results in purely USD, in USD form up to end of year, they will have to discount for the last 3 months, and that's gonna reduce their earnings. So the worst case, in fact, this is the worst case, or this is the most prudential move that Old Mutual could have done to account for that period in terms of a local exchange rate. So I think it's more prudential, rather. I wouldn't say who is right or who is wrong, but in the worst case, they are on the right side.
Moving on to KEBS, they released the half-year results to 31 December 2018. And well, notably is their loans position, which have actually scaled from $352 million in 2014 right up to $765 million in 2018. What is your assessment of the growth, or what does that actually spell out for the as far as the performance of the bank in that sense?
Okay, so what KEBS has done is to it's via Old Mutual, which is partially reflected a bit in terms of how KEBS, which is a subsidiary of their local unit, has performed. So what Old Mutual Limited, which is the parent company of Old Mutual Zimbabwe, has said is that KEBS has contributed significantly to the growth in loans in the overall loans position of the group. I think generally the loans grew by about 14 to 16% thereabout of the SA of the group, which is SA listed and also ZSE listed. So this is more of a reflection of how KEBS has progressed over the past 5 years before we factor in the 2008 full year number. So as at half year, they were sitting at 765. So the full year number is likely to be reflective of a figure which is above 765, maybe close to 800 thereabout, which would definitely improve the constant average growth rate as well as the growth rate between the years, and I'm sure that figure is now should be well over 100%. So much of the loans, KEBS loans, have been going towards a good fraction has gone towards individuals. Housing is accounting for about 23% of their net loans. Individuals about 17 thereabout, and the difference has been going to the service sector. So that's how the loans have been split. But then it's important to note that KEBS leverages on Old Mutual's sheer balance sheet position. So they've been able to capitalize well. They've also been able to get free funds that they've now committed to loaning out as in terms of as loans to the public. So their growth has mainly rode on the back of their parent company, which is Old Mutual Zimbabwe, being deep-pocketed. So they have had funds to extend to the public. But I think worth noting is that when you look at the general banking sector, there has been a decline in terms of general loans. In fact, when you look at the average growth of loans over the past 5 years, it has been muted. But rather, Old Mutual is showing that fairer growth rate at 16.7% on a 5-year basis, annualized basis. Why? It's mainly because banks have chose to invest their money in fixed securities. These are mainly treasury bills issued by government over the past 5 years, as government sought to raise money to cover some of their expenses. So banks have found it more lucrative to invest in treasury bills with a yield of about 10% ahead of investing in loans whose interest component has actually been reduced over the past few years. The RBZ has been reducing the interest which borrowers have to pay against loans. So that has reduced the allure of loaning out to individuals. Plus, there has also been an increase in non-performing loans in the banking sector.
To be topical, I wanted to highlight that.
Yeah.
We have got the ZAMCO issue that has been contentious.
Yeah.
Well, in document, the finance minister says ZAMCO was toxic. while a central bank governor that says that ZAMCO was relevant. But also in the same vein, we see a growth in non-performing loans in that sense. How safe is this corporation? That's on the one hand. On the other hand, how safe is the corporation in light of, as far as the treasury bills are concerned?
CAPS had a challenge in terms of NPLs in a few years back, but lately they've managed to contain their NPL levels to market averages. So that has not been much of a challenge, especially 2017 and 18. But I think the NPL ratio is a function of your growth in loans against the non-performing loans. So as you grow your loan book, you also reduce the ratio of non-performing loans.
Right.
So that has also helped them bring down the ratio.
Okay.
But in terms of the overall sector, I think from 2014 onwards up to 2016, the economy had kind of stagnated. In fact, in 2016, Zimbabwe had a negative growth. So in such economic situations, it's most likely that individuals failed to pay. And the interest rates were also punitive at that level. And this is about the very time that ZAMCO was introduced. So ZAMCO was introduced to clear the sector of these bad loans. And they acquired the loans. They were sitting at about 20-point-something%. And then they came off to about 6% after the cleanup exercise. Of course, lately, as you have rightly noted, bad loans have also started ticking a bit.
Yeah.
But this growth has not been as bad because the NPL ratio is below 10%.
Okay.
So I was speaking in terms of how banks have now split loans and treasury bills. And the ratio here is quite phenomenal. They have less treasury bills as a percentage of total, of funds that can be allocated to investments. I mean, that's when you compare your treasury bills to loans, the ratio is very low. But when you look at some banks like CBZ and all the other players, they now have got a more significant exposure to treasury bills than they are to loans, which is really their mandate. Their mandate is to offer banking services plus loaning out monies to individuals and corporates. And that has not been the case over the past few years. But the dynamics are really about to change as we move into 2019, given that government has slashed back its borrowings. And I think that's going to change the whole landscape in terms of the earning ability and so forth.
Well, thank you for the insights, Respect. Up next is Money Markets with Anesu Chimvumo. Stay tuned. Anesu, good evening and welcome to the show.
Thank you, Eben. How are you doing today?
Can't won't complain. Should only get better yourself.
That's good for you, man. I'm all right myself.
Beautiful. How did the stocks perform today?
Well, before we just go into the quick details of the day, there has been a sentiment that demand is pretty much subdued. Well, you'd find that investors actually want to sell off. Since before then, there was a quick drive into actually hedging into equities before the MPS because a lot of uncertainties around what the currency regime was going to be like. Now, with the currency regime having been set in place, though with a little bit of control within that regime, there has been a sense that that investors are now keen to have some more of liquid assets rather than having them in equities. So as of late, there has been a huge sell-off, which is why we come to today where the board is pretty much red, and it's actually spelling a red row here in our year-to-date column.
It's quite a bloodbath, eh?
Yes, it is a bloodbath. Except for Old Mutual that actually added about 2.03%. Now the All Share Index.
Could it be because of the results?
Maybe I can't really tell much because of the results, but then it could be probably because of its fungibility and the likeness of its fungibility would still give some investors a way out of the stock market. But as I was about to say, the All Share Index and the Industrial Index did drop 3.84% and 3.87% for both of these indices to settle at 135.54 and 451.95 points, while the Minings Index lit up about 0.68%, resultant of Bindura Nickel trade-off today, and then You've got your top 10 index that dropped about 4.71%, pretty much as a result of 9 counters out of 10 shaving off a couple of percentages on their share prices. Now, Padenga is still the only counter in the top 10 index that is still hanging in the green in terms of a year-to-date basis. So that's which is about ahead of its year opening price by about 9.22%. If we look at our rises and fallers, we had about 3 bulls and about 15 bears. Now it has been pretty much a party for the bears as of late, as they have been invading the bulls camp, with the bulls camp only being led by Old Mutual today, adding about 2.03% for it to settle at 710.79 cents, while Axia added about 1.2%, as Simbisa, which is also pretty much related to Axia in the sense that these two companies have been spun off of Insco in 2015. Now on the bears camp, ART was the largest bear of the day, coming off about 19.58% for it to settle 9.49 cents, while CBZ, which is a bank, pretty much came off about 12.44% for it to settle 14 cents. TSL extended on its losses, coming off 8.78% for it to settle at 70 cents, while Cassava, which is another top 10 stock, that came off about 9.26%, while First Capital Bank also lost about 6.33%. Now 5-day trend still has a red line right there, spelling a 6.53% and a 6.54% decline on the 5-day trend for both the all-share and the industrials index. The minings index extending that decline to about 3.56%, and while the ZEC top 10 index is almost at 10%, with offered by about 2.6% thereabout. Well, if we just look at our forex market today, we do realize that the payroll market did come off a little bit, much to do with the averages around the cash to bond to US dollar rate a little bit inching up a little bit, while the RTGS to US dollar rate actually came off a little bit from yesterday's 3.8 rate. Now the interbank rate, on the other hand, actually inched up, coming to about 2.6 points, which which is pretty much reflecting of what I mentioned earlier last night, where there was an issue to do with a certain bank which was actually trading at around about 22.64. So this should show us a reflection of how the RBZ is trying to somewhat show some sanity in their market, rather when it is actually going up faster than they are actually updating their database. So as of today, the market is still pretty firm in terms of its weakening, and it may just continue on that trajectory as we go forward.
Yeah, interesting trajectory. I'd love to see how the week actually ends. Well, thank you, Ernesto, for the insights. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website, www.equityaccess.net. Manis and I, Donkey, and good evening.